targeting Bitcoin to drop to $26,000. We went almost there at the beginning of the year, around about 30,000. We didn't hit my target yet. I'm still short, and I think we're going to. What I mean is that the bond market is speaking very clearly, has been speaking very clearly since summer last year, David. And so the economy is going into a slowdown. The growth impulse has slowed down since the summer of last year. We're still growing, still above trend by a bit, but the impulse of this growth has slowed down. And the bond market is talking. The bond market is talking via the yield curve. The yield curve is flattening very aggressively. The spread between the 5-year and the 30-year part of the yield curve has flattened to very aggressive levels. And on a metric I track, it's actually inverted a few sessions ago. So when I say the spread between 5-year yields and 30-year yields, why is that important? Because basically 5-year yields tend to indicate where monetary policy is going, right? That's the short term, the average cycle of a monetary policy. Tightening or easing is around about 5 years. 30 years, David and the audience, that is something else. That is a different beast. That is driven by the long-term possibilities, potential growth that the economy can generate. So we're talking about productivity, demographics, technology. We're talking about 30 years down the road. So we're talking about structural factors. And so when this yield curve inverts or tends to flatten, it means that the monetary policy is getting way too tight in the short term. And so that long bond traders are basically saying, if you tighten the monetary policy so much in the short term, in the long term, this will compound the structural problems the economy is facing. Unproductive debt, technology, demographics, productivity, which is very slow. Those are already strong headwinds for higher rates. If you tighten on top of that very aggressively in the front end, this will compound these problems. And so while the front end part of the yield curve goes up to reprice a more aggressive Federal Reserve, the long end of the yield curve actually remains stuck or goes down a bit. And so when it flattens like that, it's basically saying the monetary policy stance is becoming too tight. So it's the broadest spectrum. If you ask me today, do you want to be invested in the stock market? There are some sectors where I might want to say it still looks okay, but overall, stock market returns are basically driven by earnings growth and valuations changes, right? So as we have a slowdown, and we can explain later why that is the case, the prospect for earnings down the road is not very rosy. And so then we have valuations. That's the other part of the equation. And if the Federal Reserve tightens monetary policy during a slowdown, then it brings up real interest rates in an unfriendly way. And what that does, it hits valuation. It doesn't allow valuation to continue rising. And so where are these stock market returns going to come from? If they don't come from earnings and they don't come from valuation changes, then where are they going to come from? Of course, every sector is different. But overall speaking, this is a market where to be a bit more defensive than usual. And then I can move the same assessment, David, as well to other asset classes like Bitcoin, for example. Yeah. So basically, the Federal Reserve now faces a serious problem, which is it has a political incentive to try and bring American real wages up. So the wages of American people over the last year have shrunk by about 2 to 3% on a year-on-year basis. And that is reflected in the current polls of Biden. Obviously, if your wage adjusted for inflation is not going up, your purchasing power is not increasing. And therefore, your happiness as well and your ability to be able to vote for the same political leader is not there anymore. So the Federal Reserve is seeing these high levels of inflation and wages are rising, but not as much to catch up with these high levels of inflation. And so the incentive from the Federal Reserve is definitely to tame these inflationary pressures. The labor market is very tight, so wage growth is probably going to remain there. If inflation slows down, then real wages will go up. The most important power of central banks is forward guidance, is their talking, is their messaging.
Yeah.
When I talk to policymakers in my previous job, they always told me that more than our actions, we want to be able to message to the market what's going to happen. So the tightening hasn't started when it comes to hiking rates, but via their messaging, they have already told so. The economy very long term is driven in terms of potential growth rates by two things. it's demographics, and it's productivity. So how many people are literally entering the labor force? That's the growth of the labor force. And how productive are these people on a year-on-year basis? And how productive is the capital we throw through our economy? And so after the baby boomer birth boom, that basically brought the labor force to expand in the 70s, in the 80s, at very fast pace, population growth, David, has come back to its long-term average. Its long-term average, it's only 0.5% on a year-on-year basis. And so as the population doesn't grow much and it ages, the labor force reduces, right? Slows down its growth. So we have less people working. Those people are productive, but the productivity doesn't go up. Potential growth rate come down, and therefore Fed funds rate need to be adjusted downwards too. So Fed funds rate are a reaction. They don't lead, they react. So what they're really interested in is how much they pay in real terms, right? After inflation has eaten away their liability costs, they need to pay a coupon on it as well. What is this real cost they need to face, right? So it's expectation about inflation and expectation about nominal yields that drive the real yield definition. And so this year, what I expect is that the Federal Reserve will hike interest rate and signal that they are hiking.
Yes.
So nominal yields, especially at the front end of the curve, go up. They have already gone up, right? 5-year interest rates are up to 1.5% already, almost 2% in the 5 years. So nominal yields go up. And inflation expectations are not rising anymore. Why are they not rising anymore? Because the fiscal stimulus we had in 2020 and 2021, this was gigantic. This was proper money printing. This was money ending up on the bank account of people that they could spend literally in the economy. This impulse of fiscal spending is exhausted. The last time checks reached Americans was in March 2021. There's a lot of time between then and now. Inflation is driven effectively by a larger pool of money chasing a fixed amount of goods. That's how you create inflation. Now, David, the issue is, what is money? And people mess up this term a lot. And so I think that most of the money is credit. Credit that gets thrown to the private sector and that the private sector literally can spend on real goods. And do you know who creates this money? Most of this money is created by the governments when they do fiscal deficits. What do? Is they expand their balance sheet and they send resources to you, to me, for us to spend. They either lower our taxes, they send us checks. So we have more spendable power, we have more money, real money that we can spend. The other guys creating this are banks. Every time they lend, banks expand their balance sheet and they give you credit. They give you access to money you didn't have before. I created a metric, it's called the credit impulse.
Yes.
On a G5 basis, this metric is looked after for China, but not so much for the 5 largest economies. I aggregated all of them, calculated credit that goes through the private sector. This metric measures the pace of growth of credit. So how fast are you pumping credit through the economy? The faster you pump it, the more people will have literal money to spend and the more inflationary pressures are going to go up. And the largest contributor to this increase in money creation in 2020, 2021 was indeed, as you said, the COVID response, the fiscal response to the pandemic. So the governments created so much money on a G5 economies aggregate basis. On an accelerating pace, they created so much money and they gave it to the private sector. It reached the private sector balance sheet. And banks as well, they also lent because the governments were guaranteeing the losses, the potential losses on these loans. And so this credit impulse, the pace of creation of credit growth was the strongest my series has ever recorded over the last 20 years. And then the problem is that if you do not create additional credit, David, so fast like you did in 2020 and 2021, you can see where I'm going, right? It's decelerating. You might still create some new credit, but at a very slow pace. It's like a car. This measures the acceleration or the deceleration of the car. And so we accelerated big times like a Ferrari in credit creation in 2020, 2021. But now we are decelerating in credit creation big times. There is no new big fiscal stimulus. There is no new big bank lending. And so we have this cliff. For every credit sugar rush, there is always a credit cliff unless the governments continue printing at the same pace and the banks continue lending at the same pace. And gold has held up its ground extremely well. Now, this might be due to geopolitics, for example, where people look for a safe haven where to park their cash. But generally speaking, why does gold not do well when real interest rates are going up is because the marginal cost or marginal return of placing your money in dollar actually goes up, right? Real interest rates are going up. And so your marginal investor in gold will not be as attracted to that asset class as it is normally when real interest rates are going down.
Okay.
So I'm impressed by gold. It's resilient. So my outlook for gold is this would not be the asset class I'm overweighting into this year. If real interest rates go up, the marginal return of people investing in dollar rather than in gold will go up for dollar and down for gold. Targeting Bitcoin to drop to $26,000. We went almost there at the beginning of the year, around about 30,000. We didn't hit my target yet. I'm still short, and I think we're going to see quite a drawdown. And the reason is always the same. If you tighten in an economic slowdown, you reduce the marginal risk appetite people have to a very high beta risk asset like Bitcoin is. Then you will see that if people have more spendable money and this money is charged negative real rates, they will find ways to channel through risk assets, Bitcoin included. Well, stocks, it depends what sector we're looking at, right? So
okay, let's talk about your favorite and least favorite sectors, and we'll end it there.
So least favorite sector is probably at this stage small cap brick and mortar stuff. So the Russell 2000, for instance. I'm short the Russell 2000. Where do I want to be? You're going to be surprised by that. It's China. I want to be in China.
Yes.
China is pumping credit, has been doing that for already 3 months under the radar. The January credit creation in China, according to my model, was among the strongest in a single month they've ever printed over the last 7 years. So they are reaccelerating the amount of credit that goes through the economy. Xi Jinping has a Politburo meeting in November 2022. He doesn't want to be there with a weak economy. He wants to be there with a strong economy. And so he's starting his credit engine again. And when he does that, I want to be long Chinese equities.